Welcome to the Next Chapter podcast. Nobody likes to lose money on investments, but in the case of stocks, there can be a silver lining. It's called tax loss harvesting, and it creates an opportunity to reduce your federal income tax liability. So, how does it work? Is it best to start now, or should we wait until the end of the year? Well, here to answer these questions and more is our host, Registered Investment Advisor Representative Stephen Sabo from Executive Financial Group. You can learn more at mynextchapterliving.com. That's mynextchapterliving.com, or by calling 724-283-2806. Stephen, it's always so great to see you. You're just coming back from a bachelor trip, am I correct?
Yes. Hello, Alyssa. How are you? I am coming back from a bachelor trip. I have a wedding upcoming here in October. And so I was away with a couple of friends down in Deep Creek in Maryland for the weekend. So it was wonderful. We had a great time.
So fun. I'm sure this was not the topic of discussion at that trip. So I'm sorry to, bring you back to reality with this, but let's just jump right in with the basics.
Absolutely.
Talk to us about what exactly tax loss harvesting is and how we can use it to our advantage.
Yeah, absolutely. So tax loss harvesting is really just a strategy that's used by investors or their investment advisors, right, to help reduce tax liability by selling an investment that has declined in value, and thereby, you're realizing a capital loss. So this loss can be used to offset gains from other investments, maybe that you sold, or in some cases, it can even help reduce your ordinary income. Is
it better to wait until the end of the year to harvest these losses, or should people start looking at this now? We're in September. When's a good time?
Well, it's always a good time to make sure that you're tracking things along the way as the year goes on. Typically people do a lot of it towards the end of the year, only because they're starting to, the end of the year, it's one of those things where you're kind of doing your checkup, you're making sure and seeing what's going on, what took place for the year. Can I reduce my taxes? People typically wait until the end. And, a lot of the times you want to see what's going on in your portfolio. So we do wait until later in the year, but really there's no set time that it has to be done. You can do it throughout the year. And, some strategies even will utilize it throughout the year. They'll make changes and shift and rebalance the whole year. So they're, typically if you're asking an advisor, they may be waiting to the end of the year, but the strategies that maybe are moving kind of on their own in their portfolio might be utilizing it the whole way throughout the year.
And that's a great reminder that financial planning in general is an ongoing conversation. It's not just I do it once and then I'm done, set it and forget it. As much as we would like to, we have to be proactive and involved in what's happening with our portfolio. It's important. Am I right?
Yeah, that's absolutely right. Yeah. I mean, if you're not having a conversation with your advisor at least once a year at the very minimum, then, maybe it's time to start looking for a new advisor, because we like to be, like you said, have an ongoing open relationship with our clients. We want them to, come to us whenever they feel like they need something or if they have questions about it. And we want to be explaining to them throughout the year what exactly we're doing for them and why it's benefiting them in a certain way.
So there's a term that I've heard, and I don't know what it means. So I'm hoping you can explain it to me in a way that I understand. But there's something called the wash sale rule.
That's right.
What is it? And can you explain it to me?
Yeah. So the wash sale rule is really just, it's a rule that was created by the government, the IRS, that says if you buy a substantially identical security, so a stock, or let's give you an example, an S&P 500 fund, if you sold one for a loss, let's say you had a Vanguard S&P 500 fund and you sold one for a loss and you thought, well, I'm not going to rebuy that Vanguard one, but I'll buy a Fidelity one. They're going to say, no, you can't have that loss anymore. That was substantially identical. So you can't buy one within 30 days before or after the sale, or else they will disallow that loss. So you can buy something that is similar, but not substantially identical is what they call that. So another example would be, again, that S&P 500 fund. So if you sold that for a loss, maybe if you bought a total stock market index fund to replace it, that would be allowed. But if you just did two, different fund families for an S&P 500, they're going to disallow that and say, hey, you can't do that. You're basically just repurchasing the same thing.
That's a lot better explanation than I thought it was something to do with like car dealerships. You had to wash them and sell them. I don't know.
Yeah.
That puts it in terms I understand.
I'm not quite sure. I guess because they're washing out the loss on that is where they came up with that. But it is kind of a strange way to think about it. So.
Well, thank you for clarifying that. I appreciate it. So if we're talking about rules, are there certain rules that investors should avoid to ensure that they don't miss out on this tax benefit, or rules that they need to follow to ensure that they don't miss out?
Yeah, I mean, obviously the one is the wash sale rule. You really got to make sure that you're avoiding that because if not, it's going to completely wipe it out. Some of the other ones that maybe not rules, but more of a key, consideration would just be to make sure that it's part of a long-term strategy, and that you aren't necessarily overselling certain things, because a lot of the times you could mess up your portfolio in a way that doesn't really align with your goals. And so if you're just doing it to do it with no strategy, we would tell people to avoid that, because you're not really helping yourself in the long run. You might think that you are, but really now you have to kind of remake your portfolio in a way that may not be what is aligning with your goals ahead. So the wash strategy and just making sure that it fits into your long-term strategy is something that we tell people to focus on and try to avoid, just doing something to do it.
How do you balance that out? You talked a little bit about overselling. How do you find the right balance of taking advantage of something like tax loss harvesting, but not overselling?
There's so many different ways that you can do it. You got to look at it as part of it is kind of like rebalancing your portfolio. And so, it's funny. A lot of the times there are, strategies, algorithms, things like that run some of these things that kind of do it for you. So it's a no-brainer. You don't even really have to think about it. You can kind of just allow your portfolio to do it on your own. But, you just want to make sure that you're continuing to stay within your goals and what is aligned. If you're completely eliminating a position that you wanted, but you were doing it just to do the loss, then maybe it's not something, maybe it wasn't the right time, but there's a lot of factors that go into that. So it's difficult to answer in such a short term without looking at somebody's portfolio. But, just making sure that you're not completely throwing off your whole investing strategy is one of the things that we would look at.
Are there people that might be a better fit? If somebody had a higher than expected income, this might be beneficial to offset that?
Absolutely. So high income earners are one of them because the higher tax brackets are going to pay capital gains, higher capital gains depending on your income. So up to 20% federally, plus there's potential state taxes. And then possibly there's a 3.8% net investment income tax. I won't get into the weeds on that, but again, it has to do with higher income earners. Investors that also have large taxable accounts. So if you think of accounts like a 401k, an IRA, or Roth IRA, those aren't going to have any tax loss harvesting opportunities in them because those taxes are already being deferred. So it doesn't matter what's happening. If you sell something for a big gain, it doesn't matter because it's deferred until you take the money out of those types of accounts. But somebody that has what's called a taxable brokerage account, they don't have any tax benefits to them. You're paying capital gains every year, possibly, or dividends and interest and things like that. Those are going to be the accounts that are that are most beneficial for the tax loss harvesting because, let's say you have a single position in Apple or something like that, and you need to get some money, but it's, got $500,000 of a gain in it. Well, that's somebody that's going to have to, they would have some opportunity for tax loss harvesting throughout the years with a good plan to try and lessen their tax burden, I guess, moving forward. Also, active traders or rebalancers, most of our clients are not that. Some of them like to pretend that they are, or they do things on their own, and we come to find out that they've lost more money than they've made. But, and again, just for long-term planning, people that are doing long-term tax planning over the years, they would be another group of people that would really benefit from it.
That brings up a good topic. You have some of the do-it-yourselfers out there. Are there any warnings or common mistakes that you see the do-it-yourselfer crowd?
Again, everybody's good at something. And so you may be a great trader on the side, but if you're a car salesman, I'd probably tell you to stick to car salesmanship and not do this, only because, again, I could cut my own hair. It's not going to turn out great, So it's just one of those things. A lot of the times we see it. And now, especially with, during COVID and with all the online chatter and everything that you can look up, a lot of people want to do it on their own. doing. And again, some people have done a really good job, but a lot of people get caught up. It's like going to Vegas, right? You get a couple winners in there, and now you're trading and you're doing stuff and you're betting more money. And then all of a sudden you have a big loss, and well, I got to make it back. I got to get more risky, or I got to do this. And before you know it, you're compounding that problem. And so we see that a lot. And again, I don't want to discourage anybody from doing something, especially if they like it. But if we're working with clients and we're coming up with a plan for them, we always try and advise, hey, if this is something that you like to do or that you think that you're good at, why don't we take a chunk of your money, a small portion of your money that isn't going to affect you one way or another and allow you to go crazy with it. Because if it's going to affect your income or if it's going to affect your lifestyle in any way, we're going to tell you to avoid doing that. But if you have a small portion on the side that you can play with and see if you can mess around and hit a home run, then we're going to say, hey, go for it. But everybody's a little bit different.
It's like going to Vegas with that little set amount of money. You're like, if I lose this, I can still fly home. If if I go more than that, I'm walking.
That's right. That's right.
So if someone's curious to know whether or not the tax loss harvesting makes sense for them in their portfolio, how can they get started with you? What's the best way for them to connect?
Yeah, give us a call. Give us a call here at our office at 724-283-2806. You can email me at Stephen at Executive Financial Group. You can go to our website and just check us out there. Go to our Facebook page and see what we have to post. But get in contact with us and let's set up an appointment. Really the best way. It's not unlike seeing a doctor where you kind of have to be in front of them and tell them your symptoms. We want to see your accounts. We want to see your statements. And, we want to make sure that this is something that's going to work for you. Obviously, like I said, if you don't have any sort of a taxable brokerage account, then it's really not going to matter for you. But if you're somebody that has a big taxable account or you have big gains in an account like that, come and sit down with us and let's work together on a plan to say, hey, look, here's what you're faced with, and here's the different ways that we can handle this moving forward. Either in a long-term plan. Some people like a kind of the Band-Aid plan, right, where you just rip it off as quickly as possible. But again, there's benefits to each strategy, and so sometimes it doesn't always make sense to do it that way. It's better to plan it over a few years, and we can show you how it's going to benefit you and how it's going to save you in tax over those times. So give us a call, come down and have an appointment with us. We'd love to see you. We'd love to talk about it. And, hey, even if it doesn't work out, maybe we've taught you something or maybe we've learned something that's beneficial to us. So
like you said, it begins with a conversation. So if you're ready to write the next chapter in your financial story, visit mynextchapterliving.com or give them a call at 724-283-2806. Be sure to follow on YouTube and Facebook for more insights. And hey, don't forget to subscribe so that you never miss an episode. We've got more great conversations coming your way. So Stephen, as always, it's a joy to speak with you, and I look forward to next time.
Thanks a lot, Alyssa. I really appreciate it.
Talk soon.
The opinions expressed by Stephen Sabo and guests on this podcast are their own and do not reflect the opinions of this podcast station. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk and, unless otherwise stated, are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it is suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to subject covered. Investment advisory services offered through Virtue Capital Management, LLC, VCM, a registered investment advisor. VCM and Executive Financial Group are independent of each other. Pennsylvania Insurance License number 670429. Any guarantees mentioned are backed by the financial strength and claims paying ability of the issuing insurance company and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract. Stephen Sabo and/or Executive Financial Group are not affiliated with or endorsed by the Social Security Administration or any other government agency.